What's up, traders, and welcome back to Explain the Charts. Today is October 20th, 2025, and we are diving deep into the S&P 500 ETF, symbol SPY. The market is at a fascinating inflection point after hitting new all-time highs earlier this month, and we have a ton of news and chart data to unpack. First, let's set the stage with the current news, because the macro environment is painting a very interesting and somewhat conflicting picture. On one hand, we have overwhelmingly positive news from the third quarter earnings season. A staggering 86% of companies that have reported so far have beaten earnings estimates. This surge is being led by the Magnificent Seven, with their projected earnings growth coming in at nearly 15% year-over-year. Even the big banks like JP Morgan and Goldman Sachs are posting record results, pushing the financial sector's growth expectations to over 18%. This positive sentiment is so strong that betting odds for a U.S. recession in 2025 have plummeted to just 5%, and JP Morgan has even floated a potential target of 7,000 for the S&P 500. However, not everything is rosy, and it's crucial to look at the other side of the coin. Beneath the surface of the big bank's success, we're seeing signs of trouble in smaller regional banks, with reports of loan fraud causing concern. JP Morgan's own CEO warned of potential cockroaches in the credit market. We're also seeing some large players take profits, as hedge funds just conducted their largest stock sell-off in over 6 months. Adding to the uncertainty, the ongoing government shutdown is preventing the Federal Reserve from getting crucial economic data. And speaking of the Fed, while their meeting minutes do point towards more rate cuts this year, which the market loves, there are steep divisions internally on how aggressive they should be. This creates a level of unpredictability for future monetary policy and has some analysts worried about a potential AI-driven bubble. Now, let's see how all of this translates to the charts. Looking at the full daily chart for SPY, the long-term trend has been undeniably bullish. We've seen a powerful rally throughout most of 2024 and 2025, with a series of higher highs and higher lows. But that rally has not been without significant volatility. Let's zoom in on the period from early March to late April of this year to see what I mean. As you can see on the chart, the market experienced a dramatic and rapid sell-off, dropping from around 596 all the way down to a low of 481 in early April. That's a sharp correction of nearly 20% in just over a month. But what's even more incredible is the V-shaped recovery that followed, with the price rocketing back up over 10% in just 2 trading days. This period of extreme volatility perfectly reflects the market grappling with those conflicting signals we just discussed, fears of a slowdown clashing with optimism about AI and eventual rate cuts. Now let's zoom back out to the full daily chart and focus on the most recent price action. After that springtime recovery, the market continued its grind higher, culminating in a new all-time high of 673.94 on October 9th. But immediately after hitting that peak, we saw a massive reversal candle on October 10th. The price plummeted over $19 in that single session, closing near 653 with enormous volume. Since that sharp drop, the price has been attempting to recover, and as of the last close on Friday, October 17th, we are sitting at 664.39. This recent action gives us some very clear and important levels to watch. The ultimate resistance is, of course, that all-time high around the 674 mark. The bulls absolutely need to decisively break through and hold above this level to continue the uptrend. To the downside, our first key support level is the low of that big sell-off on October 10th, right around 653. A break below that level would be a significant sign of weakness and a win for the bears. Below 653, the next major support zone is the area around 649, which acted as the peak in late August. If that fails, we could see a retest of the September lows in the 635 to 640 range. Let's switch to the 1-hour chart to get a closer look at the structure of that push to all-time highs and the subsequent drop in early October. Here we can see the steady climb in late September and early October was orderly, with clear higher highs and higher lows on moderate volume. However, look at the volume and momentum during the sharp reversal on October 10th. It was swift and decisive, indicating strong selling pressure came in the moment new highs were made. This suggests that the 674 level is now a formidable resistance zone defended by sellers taking profits. Now, jumping to the 15-minute chart from last week, specifically October 16th, we can analyze the character of this recent bounce. We see the price attempting to grind higher, but then facing a significant intraday sell-off, dropping from around 668 down to 657 in a matter of hours before recovering. This choppy, back-and-forth action shows there's a lot of indecision in the market right now. Neither buyers nor sellers have been able to take firm control since the big drop from the all-time high. Okay, let's go back to the daily chart to recap and formulate a game plan. The key battleground is clearly defined. Bulls want to break the 674 resistance, while bears are looking for a break of the 653 support. So, what's the outlook? The bullish case, which I'd give about a 65% probability, is that the strong earnings reports continue to pour in and the market prices in those dovish Fed expectations. This positive news flow could provide the fuel needed to break through 674 and target higher levels, perhaps even towards that 700 mark. A close above 675 for 2 consecutive days would strongly reinforce this bullish outlook. The bearish case, which I'll assign a 35% probability, is that the market gets spooked by something. This could be a major earnings miss from a company like Tesla, negative surprises from the regional banks, or a more hawkish tone from the Fed than currently expected. In this scenario, we would likely see a rejection from the 674 resistance area and a move back down to test that 653 support. A failure to hold 653 would open the door for a deeper correction towards the 640 to 649 support zone. So, the main things to watch this week are the ongoing earnings reports, with Tesla being a major one, and any headlines regarding the Fed or the government shutdown. Pay close attention to how the price reacts as it approaches our key levels of 674 on the upside and 653 on the downside. The reaction at these levels will tell us a lot about who is in control of this market. Thanks for tuning in to explain the charts. If you found this analysis helpful, please hit the like button, subscribe, and ring the bell so you don't miss our future updates. Trade safe, and I'll see you in the next one. Finally, a quick disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. All investment decisions should be made based on your own research and consultation with a qualified financial professional.